The Great Depression. What picture comes to mind? Black Tuesday. People selling apples on street corners. Bank runs. Dust bowls. A decade of suffering. But here is the question that most people never ask. Why did the crash of 1929 turn into the worst economic disaster in modern history? Stock markets had crashed before. They have crashed since. In 1987, stocks fell 22% in one day, almost twice the percentage drop of 1929. That crash did not cause a depression. Why? The answer is not about one day. It is not about one secret company or one villain. It is about the structure, the rules, the invisible architecture that turned a manageable correction into a systemic collapse. Today, I'm going to walk you through that architecture, step by step, from the easy credit of the 1920s, to the speculative frenzy, to the banking panics, to the policy mistakes that made everything worse. By the end of this class, you will see the Great Depression not as a tragic story, but as a mechanical failure. And you will recognize those same mechanical risks hiding in the economy right now. I will show you why the 1920s were not just roaring. They were engineered to explode. Let us go back to the 1920s. The economy was booming. Cars, radios, refrigerators, mass production was transforming American life. And for the first time, ordinary people could borrow money to buy these things. Installment plans, easy credit. That credit fueled growth. Factories hired more workers. Workers bought more goods. Profits rose. Stock prices rose. It felt like a virtuous cycle. But there was a structural flaw hidden inside that cycle. Banks were lending money to stock market speculators, not just to businesses. Anyone could borrow up to 90% of the price of a stock. Put down $10, control $100 worth of shares. This is called buying on margin. When stock prices are rising, margin buying works beautifully. The speculator makes a fortune on borrowed money. But when prices stop rising, the speculator gets a margin call. The bank demands more cash. If the speculator cannot pay, the bank sells the stock, which pushes the price down further, triggering more margin calls. This is a feedback loop, a mechanical chain reaction. And by 1929, that loop was enormous. The total value of margin loans exceeded the entire money supply of the United States. On top of that, the stock market had become disconnected from the real economy. Companies like Radio Corporation of America saw their stock price double and double again. Not because their profits doubled, but because speculators expected them to double. It was a self-fulfilling prophecy. And self-fulfilling prophecies always reverse. The Federal Reserve saw the speculation. In 1928 and 1929, they raised interest rates to cool things down. But they did not raise them enough to stop the frenzy. They were afraid of causing a recession, so they let the bubble keep expanding. Then came October 1929, and the machine broke. I know you are asking, if the crash was just a correction, why did it become a depression? That's exactly what we are going to look at. Because the stock market crash was only the first domino. When stock prices crashed in October 1929, margin calls wiped out thousands of speculators. Banks that had made margin loans lost millions. Some small banks failed immediately, but the real damage came later. Between 1930 and 1933, over 9,000 banks failed in the United States. That is nearly 40% of all banks in the country. Here is the structural mechanism that most people miss. The banking system of the 1920s was fragmented. Thousands of small independent banks. No deposit insurance. No lender of last resort for small banks. When one bank failed, depositors in neighboring banks panicked. They ran to withdraw their cash. Even healthy banks could not return all deposits at once because they had lent that money out in mortgages and business loans. This is called a bank run, and bank runs are contagious. Between 1930 and 1933, there were 4 distinct waves of bank runs. Each wave destroyed more banks. Each wave made the next wave worse, because every time a bank failed, people lost faith in the entire system. The Federal Reserve, which had been created in 1913 to prevent exactly this, did almost nothing. They believed that letting weak banks fail would cleanse the system. They did not understand that a bank run does not discriminate between weak and strong. It destroys everything in its path. By 1933, the banking system had collapsed. 30% of the money supply had simply disappeared. Not because the cash was destroyed, because it was locked inside failed banks, unavailable for lending or spending. When the money supply shrinks by 30%, prices fall. Businesses earn less revenue. They lay off workers. Unemployed workers stop buying. Businesses earn even less revenue. Another feedback loop. Another mechanical chain reaction. The unemployment rate rose from 3% in 1929 to 25% in 1933. That is not a recession. That is a depression. You might be asking, could anything have stopped the spiral? Yes, two things. And the government failed at both. Stick with me for the next 3 minutes, because the policy mistakes of 1930-1933 made a bad situation catastrophic. The first mistake was monetary. The Federal Reserve had the power to inject cash into the banking system. They could have lowered interest rates. They could have lent directly to struggling banks. They could have bought government bonds to pump money into the economy. They did the opposite. Worried about inflation, which was not happening, they raised interest rates in 1931. They let the money supply collapse. The economist Milton Friedman later called this the Great Contraction. It was the single most important cause of the Depression's severity. The second mistake was fiscal. President Herbert Hoover believed in balanced budgets. When tax revenues fell, he raised taxes in 1932. That is exactly the wrong move during a depression. Raising taxes takes money out of the economy. It makes the recession worse. Today, economists call that austerity. In the 1930s, they just called it a disaster. By the time Franklin Roosevelt took office in 1933, the economy was on life support. Roosevelt declared a bank holiday, closing every bank in the country for a week. Then he reopened only the sound ones, with federal inspection. That stopped the bank runs. He also created the Federal Deposit Insurance Corporation, or FDIC, which guaranteed deposits up to a certain amount. If you knew your money was safe, you had no reason to run to the bank. These two actions, the bank holiday and deposit insurance, ended the banking panic. Within months, money started flowing again. Production increased. Employment began a slow recovery, but the damage was done. The Depression had lasted 3 years. A generation of workers had lost their skills. Businesses had gone bankrupt. The social fabric had frayed. So why does a depression from the 1930s matter to you today? I'm going to show you how the same structural vulnerabilities are still hiding in the global economy right now. Because the architecture has not changed. Only the regulations have. After the Great Depression, governments built guardrails, deposit insurance, lender of last resort, automatic stabilizers like unemployment benefits. The goal was to prevent the feedback loops that turned a crash into a depression. Those guardrails worked for decades. The 2008 financial crisis was severe, but it did not become a depression. Why? Because the Federal Reserve injected trillions of dollars into the banking system. Because the FDIC protected depositors. Because governments ran deficits to cushion the fall. That was the difference. In the 1930s, the Fed did nothing. In 2008, they did everything. But here is the structural insight that keeps economists awake at night. The guardrails are not permanent. They can be removed. They can be weakened. And the underlying vulnerabilities, excessive leverage, speculative bubbles, fragile banks, keep coming back. The 2008 crisis started in the subprime mortgage market, but it spread through the same mechanism as 1929. A shadow banking system with minimal regulation, massive margin calls, and contagious panic. The crash of 2020, caused by a pandemic, triggered a similar freeze. The Fed had to intervene again. The question is not whether another crisis will happen. The question is whether the guardrails will hold when it does. Here is your homework. Look at the debt levels in your country. Look at the margin debt on stock exchanges. Look at the leverage in the banking system. Those numbers are the early warning indicators, the same numbers that flashed red in 1928. Before we dismiss class today, let me leave you with one final observation. The Great Depression was not inevitable. It was the result of a specific set of structural failures. A stock market bubble fueled by margin debt, a fragmented banking system with no deposit insurance, a Federal Reserve that refused to act, and fiscal austerity that made everything worse. Each of those failures had a fix. Deposit insurance, lender of last resort, automatic stabilizers. But fixes can be undone, and new vulnerabilities keep emerging. The next crash will not look like 1929. It might come from crypto, from private credit, from commercial real estate, from something nobody is watching yet. But the mechanics will be the same. Leverage, panic, contagion. Here is the loop I want to leave open. If the 1930s taught us how to prevent a depression, Why did 2008 still come so close? What new vulnerabilities did we miss? And more importantly, are we missing them again right now? If you want to understand how money actually works, not the fairy tales, but the real structural rules that have governed wealth for a century, hit subscribe. Let's keep reading the receipts that history tried to erase. Class dismissed. Go look at the stock market, then look at your own bank account. Ask yourself, are the guardrails strong enough for the next storm? The answer might determine your future. I'll see you in the records.